Folks, there is an extreme amount of stock market violence heading our way. And in this video, we have several violent points to discuss. Number one, the hottest trades, the 3 hottest trades heading into this week. Number 2, the most important catalysts that are coming. And finally, number 3, the latest warning signs and developments on the market's battle. Very, very bloody battle with the Fed and inflation. As Bloomberg just headlined, quote, "The Fed has finally vanquished stocks from asset allocation throne." We will discuss exactly what that means. Let's get to work, timestamps down below. And this video is brought to you by the up to 15 free stocks that you will get when you sign up and deposit with Moomoo using our link down below. And our Australian viewers can get up to 50 Australian dollars cash back. Okay, so let's go ahead and start with the hottest of trades, Mr. Hottie McHot. So in this market bloodbathery, of course, one of the biggest go-tos has been the short indices. Shorts on this overall market are making out like bandits. SQQQ has been appearing atop our daily ZipTrader U morning briefings a lot more frequently, and it's been going parabolic week after week. SQQQ, as you know, shorts the NASDAQ 100. The short index has done very, very well in its own right as the pain has continued. But for folks with a focus on trading options on top of these indices, here's what that could look like. Say your methodology of playing SQQQ's run was buying a 50 strike call expiring September 30th. Well, just in the last 2 weeks, that specific contract has gone from 94-cent lows to $8.84, which is like an 840% run, right? So the benefit of options on large index trades is if you have a high conviction setup, you can leverage that and multiply the potential. Of course, if done incorrectly, you could also end up losing a ton more money. But the point is options are an option, no pun intended, for folks who are looking for an extra tool to leverage some of these moves on the broader indices that may not move much in terms of a percentage basis if you buy the actual indices, but could if you buy a option contract on it, right? Moving forward, though, I hold the violent belief that if we break that previous June bottom in QQQ, we are going to see the overall index shoot down heavily as that support level becomes non-existent. Right now, markets think there's a massive support level right there. I don't think that support level is going to be respected for long. And whenever it breaks, it's going to be bloody. So if that happens in this particular week that we're coming into, that would be a new round of incredibly bullish moves for SQQQ and overlying derivatives. If it bottoms out and respects that prior June bottom again, then we may have to wait longer, but I see it as a ticking time bomb. I think that the Fed's war on the stock market and asset prices is going to continue to get much worse than we saw at that bottom in June, right? So likewise, I think that support isn't going to last for long. I think its days are very, very numbered. Moving on, AVCT. So back on September 15th, we briefed on AVCT in ZipTrader U at about 20 cents a share, and it's been one of the few micro-cap setups that has really, really held strong despite this overall market bloodbathery. It more than doubled up to highs on Friday at 42 cents. It's number 5 trending on Reddit and climbing, and as we head into this week, it has all the previous weekly momentum to build off of. This play is an example of a self-fulfilling prophecy run. It's running because it's run a lot in the past and continues to attract a lot of attention. There's no specific news that I can make out, at least, that is making this run. It's just consistently getting outsized pre-market volume, and it's a very, very small stock, and it's showing a lot of proof of concept, which draws people in and makes it go up even more. And as long as it shows that proof of concept, aka it's running pre-market after pre-market, aka it has outsized attention, aka it's getting a lot of coverage, well, as long as those things are true overall on a week-by-week basis, it's going to be atop my radar. It's now held 1, 2, and 3 higher supports. If it can build that again on Monday, it can easily break out past that 42-cent high. If it gets derailed, I wouldn't be surprised, no surprisito, to see a rebound attempt into Tuesday or Wednesday. This has fought off the huge bludgeon in the broader market last week, which means it's probably decently detached from whatever happens this coming week as well. Okay, third trade idea here. So because this market doesn't like to hold runners for long, I'm looking more and more for specific and clear-cut catalysts. One of the areas where that exists is in FDA approvals, and THTX has been trading at 214 and has been downtrending like mostly everything else. But about a week from tomorrow, Monday, October 3rd, it has an FDA approval decision. FDA approvals, of course, are a huge stinking deal because they can make or break a small biotech company. This is a company worth slightly over a couple $100 million, and if it can get this through the pipeline, it would be a game changer for them. This specific product was already approved in Europe in late 2019 and is commercialized in Germany and available in many European countries through different programs such as France, Italy, and Spain, which in my view, if they're allowing it to be used in those countries, it gives it at least a solid chance of approval here in the US and with our FDA. But either way, the way that I look at FDA approvals is you don't really know what the FDA is going to decide. So you really have two potential trading opportunities: the anticipatory run before the catalyst and the post-reaction run. Whether or not it actually gets a favorable decision, you can still get an anticipatory run because markets don't know until they know, right? So there's always that extra chance that, hey, maybe this gets an approval and it shoots up, so people buy it beforehand. And that is the first trading opportunity to kind of trade off the rumor and then sell the news. And then the second opportunity is if it does get an approval and it doesn't pre-factor that in heavily beforehand, you can also have that post-reaction rally that lasts like 5-6 hours and then all of a sudden pumps back downward. Or dumps back downward, not pumps downward. Nobody uses pumps for the downward side. So anyways, whether or not it actually gets a favorable decision on the 3rd, you could still get an anticipatory run, and this is the last trading week before that decision. So I'd keep this closely on your radar, especially towards the end of the week, Thursday, Friday, probably going to see higher than expected volatility. Of course, you do want to see proof of concept. Make sure that it shows proof of concept. I hate it when people are like, oh, there's a catalyst coming up, so I'm going to go ahead and randomly buy it. And then the stock just keeps going down. Why? Because most of the time they didn't wait for any proof of concept, right? You have to have proof of concept. The stock needs to be showing some proof of concept that it can react to that catalyst, right? And building on this quick plug, I find a lot of people have an extremely random approach to the stock market. They don't have real risk management. They don't have any firm foundation. They don't know how to find and scout out news and catalysts that are relevant for actionable trading opportunities. They just kind of follow the noise of the day, what's running, what's falling, and they respond in a very reactionary, emotional way. So the goal of our ZipTrader U program is essentially to wage war on this. It's essentially our way of helping you solve that issue through our step-by-step lessons, private chat, daily morning briefings, full price target list, and other trading resources that you can look at if you click the link down below. By popular demand, we've gone ahead and reinstated a coupon code for you today. Flash40 will get you 40% off our one-time fee for lifetime access. If you are interested in joining us, it's the second link down below, and the coupon code is written down there as well. Okay, so next, let's go ahead and talk about catalysts. So on Monday, we have more lovely Federal Reserve speakers. Bostic, Logan, Collins, and Mester will be speaking. Much of what we've heard from the Fed since the last meeting has been hawkish, guiding markets lower and financial conditions tighter, the Fed yielding their soft power, and I expect more of that on Monday. Twitter is also set to depose the Musk Meister. BlackBerry and AYTU will be reporting earnings. BlackBerry in the past has been a meme stock, but these days that's a much slimmer chance. Tuesday, Jerome Steal Your Wife, Kick Your Dog Powell will be taking part in discussions on cryptocurrencies. UiPath is having an investor day. This tends to come with attention rallies after the event, and I will be looking for that on that day. Wednesday, Amazon is holding an event to announce new products and upgrades, and if Jeff Bezos has a new mistress or not, I don't believe he does. I think he's sticking with his current one. Paychex, Jefferies, and Cintas will be releasing earnings. Nothing super exciting there. It's not a big earnings week. Thursday, you have the BBY earnings report and discussion on management strategy. BBY just broke into a new cycle low, officially derailing the dramatic momentum cycle it experienced, and the last time earnings came out, the stock dropped almost 25%. This time around, BBY has a very, very important opportunity to tell the market how it's going to turn around its business, and it doesn't have a lot of shovels to dig itself out of this hole. Options chain suggests similar sized move to last earnings, again when it dropped about 25%. Earnings coming out, of course, include Bed Bath & Beyond, Micron, Rite Aid, Nike, and CarMax. Friday, Federal Reserve Presidents Bernard and Williams are speaking at a Fed conference. More volatility-inducing possibilities, and Carnival will be reporting earnings as well. Okay, lastly, let's talk about the markets war with the Fed. So as you know, the Fed recently just raised the target Fed funds rate to 325. And for the November 2nd meeting, Fed futures are now projecting a 72.9% chance of another 75 basis point hike. And this has huge consequences for asset allocation because it makes stocks extremely unattractive and makes bonds more and more enticing. Bloomberg reports, quote, "For years, asset allocators had it easy squeezy. buy the biggest American tech companies and watch the returns rack up. Those days are gone, buried under a crush of central bank rate hikes that are rewriting the playbooks for investment managers across Wall Street. TINA, the mantra that investors had no alternatives to stocks, has given way to a panoply of actual choices. From money market funds to short-dated bonds and floating rate notes, investors are now locking in low-risk returns that in some cases exceed 4%. So one of the mantras of the last 20 years was, hey, stocks may be volatile, stocks may have a bad year here or there, stocks may do this or that, but there is no alternative to stocks. TINA. But TINA, folks, TINA no more. Again, now that you can get low risk, low volatility returns that exceed 3 or 4%, people are thinking, well, why go into stocks? The S&P 500 is down 22% year to date, and the inflation battle has barely even started. Sure, inflation is higher than the amount of returns that you can get with these bonds, but inflation is also eating away at whatever the value of your S&P 500 index fund is, and that's down year to date. And the Fed literally just painted a picture of several more years of restrictive, wealth-destroying monetary policy. We'll see if they actually go through with it. But more and more capital managers are saying, screw it. Why would I hold stocks? Why would I hold my capital in the stock market when we are preparing to see substantially more dropping and higher yielding bonds are providing more and more of a safe haven and a better return? And so what happens is when a lot of capital managers start waking up to this, all of a sudden you get all this draining of capital from the stock market, which has resulted in even traditionally high performing sectors performing even worse. CNBC reported Friday that tech stocks just had their worst 2-week stretch since the start of the pandemic. And you look at the S&P 500, we're not far at all from breaking that mid-June bottom. So as the Fed embarks on this restrictive policy trajectory, you have capital managers knowing that all of a sudden, wait, going forward, we're going to have higher multiples. We're going to have increasing odds of a deep earnings recession and broad macro recession and global apocalyptic recession. And all of a sudden, these stocks are going to be extremely less competitive as compared to something like a bond. Right now, you're in a situation where the window into the future is getting very, very, very foggy. And what we can see looks very, very hawkish, very, very restrictive, very, very low or negative growth, very, very freaky McDeaky. And as long as we're in that process, money managers are going to be like, shite. Let's get the hell out of the stock market. Let's go cash. Let's go bonds. Let's do anything that's not equity related. And while that process is going on and the uncertainty is controlling the market and people are choosing to play defense instead of offense, well, stocks are going to get discounted heavily, but you're also going to have some of the most insane deals to buy once this process has gone through a little bit farther. At some point in the future, my view is the market's going to be substantially more discounted, but the Fed is going to initiate that, hey, for whatever reason, maybe we're winning inflation or maybe we're just losing economically so bad that the Fed is going to decide, hey, wait a second, we're going to go ahead and reverse policy. We're going to go back to re-stimulating. And when that happens, oof, you're going to see some of these stocks shoot up so fast that your head is going to spin off and then get reattached. But at the end of the day, this is how I would look at it. Hey, right now, very muddy, very dirty, very foggy window. We don't know what's going to happen, but as the uncertainty plays out, things are going to get discounted. They're probably going to end up getting way over discounted when all is said and done. They're nowhere near that right now, but eventually when all is said and done, they will likely get all overly discounted. And that's when you're going to have some of the most insane opportunities. I am not somebody that holds the belief that the U.S. is not going to have massive growth in the upcoming years after we get through this conundrum. I also think that we're going to have plenty of technological advances. We're going to have plenty of new products and services that are offered in a much more innovative way and much more profitable way. And these are all things that I believe are going to cause the stock market to do very, very well after we get through this current restrictive cycle. Anyways, that caps off the video and my thought process. Let us know what you think down below. Make sure to get your up to 15 free stocks with Moomoo. Australians can get a up to $50 Australian cash back deal. And if you want to get 40% off our one-time fee for ZipTrader U, I will put the link to that down below. Coupon code FLASH40. Anyways, have a good rest of your day, folks, and we'll see you in the next video.